I love the bucket system because it takes a subject that seems extraordinarily black boxy, setting an asset allocation mix for retirement, and makes it very concrete and intuitive. And I believe that it works in practice. I've heard from scores of retirees over the years that their bucket portfolios were helping them enjoy their retirements without worrying about periodic bouts of market volatility. That is a quote from the chapter in Christine Benz's wonderful book, How to Retire, that we are going to get into today. For those of you who have been on this journey with us, this is actually How to Retire Part 6, and we are going to continue to wind our way through these lessons. So today, actually, Christine Benz is going to be interviewing and being interviewed by Christine Benz. But she actually got one of her friends to the questions so that she wasn't actually just talking to herself. And the topic of this chapter is sort of what that quote would lead you to believe, which is putting together a portfolio of assets that makes sense. Now, this might be my bias because I've got a lot going on in my life, 7 children, 7 dogs, all the rest of it. I have an intense need for the various things that I employ to be practical. It doesn't matter how good they are if you cannot use it. And the reason that I so gravitated to this chapter, and I think it's probably one of the better chapters that we've done so far, is Christine is always going to bring this back, this method of portfolio construction, to something that is very usable, very workable, very practical from the retirement perspective. So let's get right into this. They go through a lot of really great information. The first question, Susan is her friend who's going to be doing the interviewing. So they're going to address a common misconception or a common strategy for generating your income in retirement. And that's sort of the basis of the first question. So Susan says, it seems like that's a common issue. People want to subsist on whatever stream of income their portfolios can generate. Why might taking that approach introduce risk? Now, for those of you who've been watching our kind of FinTalk segment of the podcast where Scott and I will get a video off the internet, we'll react to it. This is going to be very familiar because there was an episode that we did where we addressed this sort of need that people have to create a portfolio of assets, and they will just take the income stream from that, leaving the corpus or the principal alone. And Scott and I got into why that would not be such a good idea for a young person to do it. And Christine's going to touch on why this might not be a great idea for a person who is retiring to do it. And she says, it's definitely the most intuitive way to think about extracting income from a portfolio. I remember when I got my first passbook savings account at the local bank and deposited $200 in birthday money. Interest rates were higher then. This was the 1970s. And I did the math about how much I would need in the bank to be able to live off of the income. This is a very intuitive way of going about investing your money. All of us like to think, if I just left this alone, how much income could I take off of it and yet not inhibit the investment's ability to continue to provide that? I have no qualms with people feeling this way about their money. It's a very intuitive way of feeling at it. But she goes on. Our first experiences with investing usually have to do with earning an income just like that. So I understand why retirees gravitate toward this approach. And many older adults do want to be able to leave something behind for their loved ones. That would be the corpus of the investment after they've gone. So generating and living on current income seems ideal from that point of view. But I remember speaking with a family member who had retired, and this was during the mid-2000s. He was telling me he had made a large purchase of General Motors bonds because they generated the kind of income he was looking for in retirement. I don't follow individual companies closely, but I remember thinking, automakers are incredibly cyclical and sensitive to what's going on with the economy. They can be volatile, but their yields were much higher than the broad market yield, in part because of some of the issues they had. And of course, U.S. automakers ran into a huge problem, the Great Financial Crisis. That experience made me realize that people need to stop being so hung up on subsisting on income alone. So that was a really long-winded way of Christine saying, look, you think that you're de-risking your retirement income by creating a portfolio that will pay you enough in just current income, dividends, cash flow, interest, that kind of thing, for you to subsist on. However, what she's getting at here is that often to accomplish that, you will have to align pretty much every element of your portfolio in one specific direction, and you will be exposed to one very specific risk if you were to do that. Now, if you had constructed a portfolio that was 100% bonds, that would have kicked along okay. I mean, interest rates came down a ton after this point in time that Christine's talking about, the 1970s. But you might have felt like your portfolio was relatively safe from the stock market because all you had was bonds. You were taking the income off of those bonds and you were doing just fine. But then 2022 came along. And in 2022, interest rates rose and they rose rapidly. So your bond portfolios were down 10+%. And so you might have been operating under the illusion of safety. But in all reality, you would just expose your entire portfolio to one risk in particular. And that really hurt bond investors in 2022. So Susan goes on to ask, why do you think a total return approach is a better way to do it? And so Christine says there are misconceptions about what total return investing actually means. It doesn't mean that you don't care about generating income at all. The income distributions you receive are going to be a component of your returns for sure. Dividends have composed a big percentage of the stock market's long-term gains, but so will the appreciation in your investments. Total return investing simply means that you're going to seek gains from both sources and that you'll generally reinvest your income distributions. And that's an important element of that she's going to touch on more. When you're talking about taking an income out of your portfolio, remember, your portfolio is totally agnostic to how it is that you're sourcing your income. It does not differentiate one bit from what is an interest payment and what was principal, and you shouldn't either. The whole question of taking income out of your portfolio is essentially asking, what's the liability that we're putting on the portfolio? This would be the present value of all of the cash flows you're going to have to take out of it. And what's the size of our portfolio in relation to that liability? And again, how you go about taking cash out of the portfolio, interest, dividends, or actual principal, it does not really matter as long as we keep the right balance. Do we have enough assets to satisfy the ongoing liabilities or the ongoing cash flows? Christine goes on to say, that way, when retirement comes, you're going to be agnostic about how you source your cash flows for your living expenses, and you're going to be able to stay flexible. The basic idea of using a total return approach to manage your retirement portfolio is that you're not disproportionately favoring income producers, and you're mainly harvesting appreciated winners to meet your living expenses. The name of the game is to grow and maintain your portfolio. When it comes time to take cash flows for your living expenses in retirement, your portfolio doesn't care if you're pulling income distributions or if you're taking appreciation. So you might sell stock. You might sell a stock that's gone up a bunch and take some of that off as income. I'm going to have some thoughts on how it is that you should actually go about sourcing the income from the portfolio that would differ from Christine's thoughts on it. But we are in alignment on that issue, is you should be totally indifferent about how it is that you go about sourcing the income from your portfolio because your portfolio is definitely indifferent to it. Now, that doesn't mean that you don't consider the risks of selling stocks versus the risks of selling bonds, or that you don't consider what the future value of those investments might be if you decided to sell them versus if you decided to keep them on your portfolio. And that's something I'm going to get into here in a little bit. But it does say that this allows you should take a little bit more of a flexible approach and not necessarily think that your income can only come from what it is that your portfolio produces in cash. It's just not a very flexible way about sourcing your income needs in retirement. So Susan says, we finally get into the bucket approach. You've become a big believer in a bucket approach to retirement portfolio management. How did you become aware of this strategy? So Christine says, I was bothered by the fact that so many retirees seemed fixated on just pure income generation. So I started reaching out to some well-regarded financial advisors to find out how they built retirement portfolios for the clients. Morningstar's former director of research, Don Phillips, put me in touch with Harold Evensky, who is a professor of financial planning and also oversaw a very large financial planning practice with his wife, Dina Katz. Harold and I had a long conversation about how he managed his retired clients' portfolios. He told me that he builds a total return portfolio of stocks and bonds, but also bolts on a cash bucket. The goal of the cash is to provide cash flows for the rare market environment when neither stocks nor bonds perform well. Now, for the listener, that is going to be something that's extremely top of mind because 2022, though I cannot believe that was 3 years ago, feels like it was yesterday, where cash really was king in 2022. It was the only asset that really escaped dramatic devaluation during that year because as interest rates rose in response to inflationary pressures, bond markets were off and the stock market, anticipating some sort of recession, really came down a lot. And that did ultimately resolve in 2023 and 2024, but 2022 was a very uncomfortable year for both the stock and bond investor, and that was sort of the impetus of the episode Scott and I did on the death of the 60-40 portfolio. You heard a lot about this near 2022, which suggested that 60-40 portfolio had failed to deliver to its investors, essentially, what had been a long-standing promise, which was we are going to take a lot less risk than the total market, but we are going to provide you with adequate total returns in order to help you accomplish whatever financial goals you might have. That was true for a long time. And what Scott and I said in that episode was the 60-40 portfolio is not dead. It was just hired to do the wrong job. And we'll get into really kind of how we think about the way we structure portfolios in retirement, how it differs from Christine's here in just a second. So Christine goes on to say, this made a tremendous amount of sense to me, and Harold indicated that it really seemed to work from a behavioral standpoint too. He said that he would often call his clients during a period of market turbulence just to see how they were feeling about the volatility. Invariably, the response was, I'm not worried. I know I've got my cash bucket that I could spend from if I needed to. I was so struck by the power of that simple strategy from a behavioral standpoint. Its power to let people tune out the markets and enjoy their lives. The cash bucket gave his clients a sense of control that they could still carry out their plans, the things that constituted quality of life for them, whether it was going to dinner with friends every Saturday night or talking to or taking the family on a cruise. I just love that notion because so much of life is being able to look forward to things and plan them. And the note that I made to myself there was like, that's sort of the point of your money in retirement. And this was definitely true in the episode we just aired with Richard, where he said, your retirement portfolio exists for one explicit purpose, and that is to serve you in your retirement, is to allow you to do the things that you want to do. Now, Christine's approaching this question from a cash bucket approach. I've approached this question from having a lifetime income stream in addition to Social Security with an annuity. Not an explicit recommendation, but the data would suggest, and I'm venturing that that's what Christine is getting at here, those households that have a cash bucket covering about a year or two's worth of income needs so that they could tap it if they need it, and those households that have a lifetime income stream in addition to Social Security, they frequently report feeling more confident in their financial situation, feeling happier about their expenditures, feeling happier about their life in general in retirement. And they actually tend to consume a little bit more of their portfolio, in part because they know that they can always rest on this lifetime income stream or this cash bucket, but they don't do so to their detriment. And what I mean by that is they're not at any great risk of running out of money. They're working with a person that question's really been asked and answered, but it seems as though they're a little bit more willing to have those experiences that Richard talked about in that episode, where once you get into your 80s, if you haven't done the things that you want to do, the real question is that, or the real response is that you're just not really going to get to do them. So I love this idea of having a cash bucket, having something for clients to look at that will give them the confidence to continue to live the life they want to live, even if we do go through another period like 2020 or 2022. I think that that's a wonderful asset to have. Susan says, how many buckets do people need and what should go into them? Great question. Harold was pretty minimalist with them. This is what Christine was saying. And while he was always supportive of me talking about the bucket strategy, I suspect he thought I got a little carried away with multiple buckets. He used the cash bucket and then just a pure total return bucket, and that was that. However, I tend to favor a 3-bucket system. Christine and I are fairly aligned on this point. A cash bucket consisting of a couple years worth of portfolio spending needs, an intermediate term bucket mainly of high quality bonds with another 5 to 8 years worth of portfolio withdrawals, and a third bucket for growth. Together, the cash and bond buckets provide a runway of safer assets that a retiree could spend from if a bad stock market materialized. With those 2 buckets, the retiree would have anywhere from 7 to 10 years worth of portfolio withdrawals in a fairly safe asset. That provides insurance in case stocks were to go down and stay down for a long period of time. So another way to think about this is Christine is advocating for matching your assets with your liabilities, okay? And she's talking about matching them very specifically, and we're going to use a word that's common in the literature or financial planning space, with duration. And so what she is advocating against is using long-term assets, something like stocks, to manage your short-term liabilities. And in retirement, your short-term liabilities are just your income needs. So she's saying, why would you not match the duration and therefore, in many instances with bonds, the risk with the point in time at which you're going to need to turn an asset to cash? So first couple of years of income are going to come from very short-term investments, money market funds, ultra short-term bonds. That makes a lot of sense to me, because why would you put the assets that you know you're going to need to spend very shortly at any market risk whatsoever? It doesn't add up. We wouldn't advise a client do that. And this would be the same if you were a young person and you knew you wanted to make a down payment on a home in 3 to 5 years. You definitely wouldn't want to put that money at risk, because as we saw just here in April, the stock market can lose value very rapidly. And you just wouldn't want to have lost all the value right when you needed to make that down payment. And you certainly, as a retired individual, wouldn't want to see your portfolio contract dramatically right before you knew you were going to take a big cash flow out of it. So total in alignment there. So she's advocating for essentially an asset liability match or a cash flow match. These are very common investment strategies, but they are not quite as intuitive as just taking the income off of it. And really the way that I would think about this approach is you're setting up a hedge, right? So you're setting up a hedge which will allow you to spend down your portfolio without encumbering the riskier part of it, generally for people that would be the stock portion of their portfolio, by ongoing distributions. Very difficult to predict what the stock market's going to do in a given year. I think economists demonstrate their sense of humor or lack thereof when they use decimal points in their forecasts, because that's kind of hilarious to make it that specific when nobody really knows directionally where it's going to go. So stocks just do not make a great asset from which to spend. Bonds, however, though they can lose value, they certainly did in 2022, they just tend to have a much smaller variance or standard deviation than stocks, making them a more appropriate asset from which to spend. So Susan asks, how did you arrive at the asset classes that go into the buckets for each of the 3 time periods? And this is where Christine kind of gets into it. The idea was to match each time horizon or holding period to an asset type that is likely to have a positive total return over that same time horizon. If you have a very short time horizon, like less than a couple of years, the only asset type that will reliably stay positive over such a short holding period is a cash type investment. If you have a slightly longer expected holding period, from say 3 to 10 years, bonds, especially short and intermediate, high quality bonds, so this is going to be something that would be considered investment grade, have a great track record of holding their ground and not losing value over that time horizon. She is not saying that it's impossible for them to lose value over that time horizon. They just have a really great history of not doing so. For stocks, which would be the last bucket, we assume a 10-plus year time horizon because stocks have been quite reliably in the black, assuming you hold them for at least 10 years. But once you start to shorten that holding period, they're much less reliable. And all of that is just reiterating what I said before. You are matching your assets in your portfolio at a point in time when you might need to turn them into income. And so in our practice, we never make a purchasing decision regarding an asset if we don't have a distribution date for that asset in mind. Now, it doesn't have to be down to the hour, but I'm saying, is this a 3-year asset? Is this a 5-year asset, a 10-year asset, or a 10-plus year asset? Because that's really going to indicate where it is in your portfolio that it's going to rest and what sort of investment we're going to buy with this money in mind. So Susan says, you mentioned that holding 7 to 10 years worth of spending in cash and bonds would help a retiree avoid spending from stocks while they're down. Is that how a bucket system would always work? That a retiree would spend from their cash bucket and then move on to the bond bucket and on down the line? So Susan's really trying to pry into this and say, how is this going to work in practice? Like, where are we going to source the income? Is there going to be rebalancing? How is this going to go? So Christine says, no, not necessarily. That sequential sort of spending approach would come into play in certain time periods. A 2000 retirement would be a good example. U.S. stocks sold off, especially large company growth stocks, and basically stayed flat for the next decade. A retiree could have spent through the cash and bonds and not needed to touch their stocks during that decade. Interest rates largely declined from 2000 to 2009. That was very good news for bond prices. Not only did bonds hold their ground, but they gained in value during that period, making them wonderful assets to sell during that time. In a lot of the other market environments, though, stock gains in value. Rebalancing back to the retiree's desired asset allocation by selling stocks can provide cash flows for the years ahead. The retiree could leave the safe assets in the portfolio alone. So this is where we're going to deviate fairly significantly from Christine's viewpoint. So basically what she's saying is, no, we don't necessarily only want to spend down from one part of the portfolio, because what that would mean for the retiree in question is that your portfolio is getting incrementally riskier over time. Now, by way of example, I hope to really kind of pick through this and demonstrate how that's not necessarily the way that you should think about it. So Christine was on the right track when she said you really want to buy assets that have a timeline match to the liabilities associated with them. And in retirement, that's your spending. But another way to think about the liability on your retirement portfolio is just the present value of all of the cash that you're going to need to take in income over the course of your retirement. Now, you can discount that back, thinking about what you might earn on those investments and adjusting it for inflation and all of that. And if we've done this work properly, we should really have a number that represents the liability. And that number in retirement is as large as it's ever going to be right on day one of retirement, and it's going to get smaller over time. So that liability is going to roll downhill as years go by. That's one fewer cash flow that you need to produce in order to live the life that you want to live until it is that you move on to the next thing. Now, in all of our years of working, what we'll say is ultimately everybody has gotten to the end of their life. And so that's going to be true for the listener too. And so the way that you should be thinking about your portfolio is that the liability that it needs to sustain is shrinking over time. And that's why a traditional rebalance just does not make a whole lot of sense in my view. Rather than rebalancing, your portfolio should continue to reflect the real risk, okay? And the real risk in retirement is a permanent loss of value that prohibits you from generating the money that you need to generate in order to live the life that you want to live. Measuring risk in retirement by just taking the standard deviation of your portfolio is not the appropriate way to do it. And here's why. Let's just say, as an example, a person retired and had a 50-50 portfolio, $500,000 in stocks, $500,000 in bonds. Let's say they needed to spend $50,000 a year. Fairly typical rate of spend on $1 million portfolio would be about 5%. Not a recommendation, just saying we've seen it. Now, let's just suspend our disbelief for a second and say bonds appreciated in their portfolio by $50,000. It's a 10% appreciation, but unusual, but not unheard of. Let's just say that happened and they took all of the money out of the bond portion of their portfolio. So they got all $50,000 that they needed from there. Let's also assume during this year that stocks went up 20%. Okay, so stocks went up $100,000. Unusual year for this person, but just bear with me. Now let's examine what's happened. They've had a year of retirement. They took $50,000 out of their bond portfolio, and it's still worth $500,000. They didn't take any money out of the stock portfolio, and it's now worth $600,000. So now they're 1 year into retirement. They have a $1.1 million portfolio, but by way of typical risk analysis, you would have to say, if you're just measuring by standard deviation alone, that this retiree is now at greater risk than they were just a year ago. Even though they have a larger portfolio, they have the same amount that they had in fixed income, and they have more in stock. And the only reason that a typical way of viewing risk, which is just by the variance of the portfolio, that a person would say they're at greater risk is because the riskier portion of their portfolio is now larger than it was before. Think of how illogical this is. If you wanted to just manage risk in retirement by way of standard deviation, you would prefer from that measure that your portfolio decline, but each asset class in direct proportion to the other. So they would suggest that $450,000 in bonds and $450,000 in stocks, because now you're still at your desired quote unquote 50-50 allocation, would be better than $600,000 in stocks, $500,000 in bonds. Now, if you're anything like me, that doesn't make sense, not one bit. And it actually reminded me of the old Jerry Seinfeld quip where when people are surveyed, they often report having their fear of public speaking is higher on this survey than their fear of death. And his joke was, that means if you were going to a funeral, you would rather be in the casket than doing the eulogy. It doesn't make sense. So I am definitely opposed to this method of trying to find some semblance of some vague notion of a risk tolerance. And what we generally mean by that is how much variation you're willing to accommodate year to year. And instead, we try to counsel retirees that the real risk is that present value of all the cash that they need to take out of their portfolio over time. We have to hit that number or their retirement is just not going to be worthwhile. Now, if stocks go on a little bit of a run and bonds are not falling dramatically behind and we still have enough in terms of safe assets to manage the immediate income needs, I don't think that there's any real need to rebalance. And the reason for that is stocks, if held for a 10-year or 20-year or 15-year period, have regularly ended in the black. And it doesn't really matter the point from which you begin. And so much of that stock portfolio is going to be held for more than a decade. So rebalancing is often giving up a lot of return down the road in order to maintain this sort of 50-50 portfolio in order to manage the variance. Doesn't make sense. But Susan goes on. One knock on the bucket strategy is that cash is usually a pretty low returning asset, and that's especially true once you factor in inflation. What's your take on that critique? And I've got some notes on this part too, but we'll get into what Christine says here real quick. Christine, it's 100% true that cash does have an opportunity cost, so you definitely don't want to overdo it. Holding, say, 5 years worth of portfolio withdrawals in cash is probably overkill. Once inflation is factored in, your take-home return is going to be very low. On the other hand, we saw the value of a cash bucket for retirees in a year like 2022, when both stocks and bonds lost value at the same time. A retiree with cash on hand could have used those funds to provide spending money and would have been able to reinvest the income and distributions from the stock and bonds back into the portfolio. One big benefit is an intangible one, peace of mind. Knowing that the cash is there can give retirees comfort that market volatility won't disrupt their spending plans and may make it easier for them to stick with their long-term portfolio. So, a couple of notes on this. Is a fair question to ask is how sensitive has spending in retirement been on average to CPI or other broad measures of inflation? And Scott and I have covered this at length before on the podcast. Retirees are not that sensitive to inflation on average. Now, the real thing that you ought to do in retirement is just measure your own idiosyncratic risk when it comes to inflation, which is just to get a good sense of how sensitive are your ongoing income needs to a very broad measure of inflation. Because typically what people mean by inflation is CPI. But CPI is a very specific basket of goods. And that very specific basket of goods may or may not be a great representation of what an average retiree, needs to spend year over year. And what we can tell you from 10 and 40 plus years on Richard's side in the business, income needs in retirement do not go up in lockstep with inflation like a lot of financial planning software models. It's a very conservative assumption, and it's really wonderful to know that your plan could sustain such a regular increase in your income need, but it's just not that sensitive to inflation. Now, I am not here advocating that a person hold 5 years worth of income in cash. I do think the opportunity cost there would be quite significant. I just don't think the erosion of your purchasing power by way of inflation is quite as dramatic as some people in the financial planning space might have you believe. And so but the intangible portion of it, which is the peace of mind that she gets at, I really like that. You just don't need to have quite as many years of cash flow in cash as, say, 5, but I think 1 to 2 is fine. But the other thing that I wanted to critique was a lot of people will examine cash and they'll think, well, my total return is just not going to be very good. But you got to remember that cash is on the portfolio to be spent in the short term. And so one of the things that I like to do is, and this will be true when I'm teaching my kids to drive, which is a nightmare that's sneaking up on me faster than I can ever even imagine, is to tell them that when you are going various rates of speed, the rate at which you travel or how fast you drive is going to be giving you very, very marginal benefits over time. So an easy exercise would be if you only needed to travel 1 mile, how much time would you save at various rates of speed? Because this is sort of like if you've got cash in your portfolio. Saying I only need to go a mile, I only need 1 year. And so my point was if you needed to go a mile and you would travel 10 miles an hour, that would take you 6 minutes. That's how long it would take you to go. So if you took your speed up to 30 miles an hour, that same 6-minute trip would now be 2 minutes. So congratulations, you've saved 4 minutes. That seems like meaningful time. However, what if instead of driving 30, which is your typical speed that you could go, say, in a neighborhood, you decided, nope, I want to make this 1 mile trip at 50 miles an hour? You would only have saved yourself 80% of a minute. So but yet the risk of getting in an accident, hitting a pedestrian, hitting a parked car, hitting a mailbox, way up at 50 miles an hour. And then from 50 miles an hour to 80 miles an hour, you go from that journey taking you 1.2 minutes to 3/4 of a minute. So you think these time savings are absolutely trivial over very short distances. I would much rather have a person safely drive at 30 miles an hour, get to their location in 2 minutes, than to go 50 miles an hour to get there in 1 minute and 15 seconds. It just doesn't make any sense. And so that's the critique of the cash, is people saying, well, we're giving up a lot of total return because our cash is on there. But it's like your cash is on the balance sheet for a year. And so the weighted average cost of holding that cash on the balance sheet for that short period of time is offset by the years where cash, like in a year like 2022, is a wonderful investment, and it prevents you from selling your other assets at deep discounts. So that would be my primary critique, or that would be my rejoinder to saying, hey, well, isn't that going to be cash drag? It's like, not really. because we're only going to be holding it for such a short period of time, and all of the other assets are going to be producing a total return. So they finally they end this with how to customize a bucket of or a bucket portfolio's asset allocation. And Susan just asks plainly, how can retirees customize a bucket portfolio based on their own situations? And so Christine gets into this and she says, the first thing that you need to do is figure out how much income you're actually going to need from your portfolio. Really quick way to do this is just to assess how much income you're going to need to live the life that you want. Subtract out what you're going to be receiving in pensions or Social Security or any other outside income needs. And that is going to give you the amount that you're going to need to take from your portfolio year over year. You can then also inflate that by inflation every single year, but that will give you a really great starting point. And then the next step was to see if that seems like a sustainable starting withdrawal percentage. That's where you would work with someone like me. You put together a financial plan. The first thing that you do is basically a simple feasibility analysis. Can the portfolio reliably sustain this income over a 25 or 30 or 35-year retirement? If that is asked and answered, you can move on to the next step. If there are some real questions as to the feasibility, then it's a totally different conversation. And then she says, in terms of structuring the actual bucket portfolio, I'd say using this $35,000 anticipated withdrawal, this is on about $1 million portfolio. So I'd have roughly 2 years of those withdrawals or $70,000 in cash, and she's not discounting that at all for what she might earn on a money market fund. So she's not doing that at all. She's just pure multiplication here. And then in the second bucket steps on the risk spectrum a little bit, but not too much. This will be mainly high quality bonds with a focus on short and intermediate term investment grade bond funds. Assuming a $35,000 annual expenditure to hold another $280,000 or $35,000 times 8 years worth of withdrawals in bucket 2. Now, this probably overweights the fixed income bucket quite a bit, and the reason for that is these things are earning a substantial, not a non-trivial rate of return. So you could actually discount the amount that you would be needing to put in there by about what you thought you might earn on the bonds. You could adjust it for inflation, which is what I imagine what she's doing here, and just essentially zeroing those returns out. But this approach where you just multiply the number of years of income that you're going to need and just put that product into the bonds, very likely going to overweight your bonds because you're not discounting it by what they're going to earn. She would put another 8 years worth of cash flows in the bonds, and then really the balance of the portfolio would go into stocks. Now, this is a very reasonable way to produce your asset allocation. It's saying I want 2 years in cash, and you probably don't need to discount that at all, another 8 or so years in bonds, and then just the balance of my portfolio in stocks. Why? Well, like we've talked about before, the liability that you need to cover, which is just the present value of all the cash you're going to need to take out of your portfolio, is absolutely highest in the early stages of retirement. And this is critical because you're at the greatest market risk. It's something called this phenomenon is called sequence risk. You're at the greatest risk early in retirement if you experience a very negative outcome. And the reason being is even if returns that you experience later in your retirement were sufficient to bring the average total return of your portfolio back up to something like 8%, if you don't have a very large portfolio to participate in those later gains, you're just not going to be able to continue to take out the income that you need. Now, that is a really confusing kind of phenomenon because we've been taught if you have a series of numbers, say 5, 6, and 7, if you multiply 5, 6, and 7, no matter how you mix those numbers up in whatever order you put them, you should always come out with, I believe it's 210. So 5 times 6 is 30 times 7 should be 210. Now, you could do 7 times 6 times 5, 7 times 5 times 6. It doesn't matter. However you order those things, you're always going to get the same result. But that's not how investment math, when you're taking money out of a portfolio, works. And one of my favorite examples of this is, imagine being approached by somebody who wanted you to play a game that was just a simple coin flip. You flip a coin. If it lands on heads, you increase your wealth by 50%. And if it lands on tails, you only decrease your wealth by 40%. Now, at first blush, this seems like you should bet the farm on this coin flipping game. Because if it's a fair coin, half the time, you're going to increase your wealth by 50%. And the other half of the time, you're only going to decrease your wealth by about 40%. But that is saying that you're going to get the arithmetic average of those things. And that's just not how investing works. So the best way to analyze whether or not this is a good game to be playing is you can just do it with very simple 2-flip analysis. And you can only, much like as an investor, you can only bet on the next flip what you have left over after the first flip, okay? And this is a really easy game to play. So after one flip, if you got heads, you'd have $150. If you got tails, you would have $60 because you would have lost 40% of your wealth. Now, there's only 4 ways that you can go through 2 flips. Heads, 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 tails, tails, heads, tails, tails. And we'll go through all of them. If you got heads, heads, you'd end up with $225. So that's 100 to 150, 150 to 225. Pretty good deal. If you got heads, tails, you'd go from 100 to 150, but then on the tails, you'd actually lose 40% of your wealth. You'd go back to 90. On tails, heads, you'd first start off by going down to 60, and then you would improve your wealth back up to 90. And on tails, tails, you'd go down to 36 because you would go from 100 to 60 and then from 60 to 36. So if you followed me there, and I know I went through that kind of quickly, but the ending wealth values, if you could only continue to bet on this coin flip game with whatever it is you had left over after each subsequent flip, would be 225, 90, 90, and 60. Now, if you were to take all of those numbers and add them together and divide by 4, you would come to discover that, yes, on average, everybody should be wealthier. I think it's like $105 or $110, one of the two. However, in reality, all of that wealth is concentrated at the top. And that's that person who was the lucky one who got heads, heads, 225. And the person at the bottom who got tails, tails has a fraction of their wealth. I mean, they only have 36% of their starting wealth. And that's really to demonstrate the power of negative compounding. Is if you get a really bad event early and you drop your wealth by 40%, even if the next return is 40%, 50%, 60%, you're not even back to even. And now your portfolio has meaningfully shrunk. So that is this notion of you got to be really careful with how you're assessing the way that you're earning your returns in retirement. And you have to know that once your full portfolio is invested in the market, you're no longer working. You're not adding anything to it. You are just like this coin flip example, where the only thing that you're going to have at your disposal is going to be whatever is left in your portfolio every day, every month, every quarter, or every year. You can only continue to proceed in your retirement, barring getting another job or anything like that, with what it is that you've invested. And it doesn't really matter what period over which you analyze it. You're always going to be at greater risk early in your retirement than you are late, because that present value of all the cash you need to spend is so large in the beginning, and it gets gradually smaller as you go along. So they go on and they talk about the bucket logistics. So Susan says, assuming someone has set up a 3-bucket system, how would they go about maintaining those buckets? And this is, again, where Christine's going to provide her thoughts on rebalancing. There are a few different ways to do it. The first way would be a pure total return approach, where the income distributions are getting reinvested back in the portfolio and the retiree is just spending from the cash bucket on an ongoing basis. I love that. That makes all the sense in the world to me. It addresses all of the concerns that we've laid out. Saying you've got very short-term liabilities, we're going to finance those with very short-term assets. So far, we're on board. Then periodically, the retiree would rebalance appreciated equities or bonds and use the proceeds to refill the cash bucket. I only have issue with a portion of that. I would probably not rebalance periodically from equities, because you are making a timing decision with regards to the stock market at that point in time. And so it might feel very intuitive to say, whoa, my stock's up 20%. We ought to take some of those gains off the table. But it's like, no, you have a long time to be a stock investor. And more often than not, by taking money out of the stock market, you are inhibiting future returns rather than protecting yourself from a risk perspective. So if you're saying, well, Greg, she's given me some solutions, you're just out here cutting her down, what would you do? Well, if this were my portfolio, or portfolio was managing on behalf of a family member or a client, I would say, yeah, we can have 2 years of portfolio withdrawals in cash, but that doesn't necessarily mean we use that right away. So if bonds are doing fine, we can be spending down the bonds, leaving an emergency fund's worth of cash, maybe not quite 2 years, maybe more something like 1. And then if we run into trouble in the bond market, we can go to the cash. And generally speaking, the bond market has resolved itself very quickly. Now, that's not always going to be true and hasn't always been true, but that generally speaking will be the case. And a year's worth of portfolio distributions would generally give us enough time to where bonds could recover like they did after 2022. And I would feel comfortable going back to spending down the bonds. Now, remember, you bought longer dated bonds for your longer dated cash flows, but every year that goes by, those bonds are becoming shorter and shorter dated bonds. So I don't feel a real compelling reason to rebalance when you know that is ongoing. It's going to happen organically. Those bonds are going to start moving closer to their maturity. So you buy an 8-year bond, 1 year later, it's a 7-year bond and 6-year bond and so on and so forth. And you've matched that with a cash flow at a point in time closer to when that bond would have matured. Now, if you're using funds, you're maintaining your duration exposure on these various parts of the curve. And I suppose year over year, you could rebalance from an intermediate bond fund to a short term to an ultra short. I don't mind making those sorts of timing decisions as much on the bond side because, again, the variance of those total returns are just much narrower than on the stock side. I do not like a rebalancing system that relies on making timely decisions to pull money out of the stock market to flush out your bond portion. Alternatively, the retiree could use the same general approach and not spend from the cash bucket unless the rebalancing proceeds in a given year were sufficient to provide cash flows for the year ahead. That's exactly what I said. I said, maybe we don't necessarily tap into the cash bucket unless there's a very compelling reason to do so. And that allows that means we can kind of get away from making these timing decisions with our riskier assets. The specific approach to bucket maintenance really depends on the retiree. But as I've been thinking more about behavioral factors, I've gotten to like the hybrid approach because the income distributions provide a nice baseline of cash flows on an ongoing basis. And in turn, the retiree won't need to do much rebalancing or fiddling with the portfolio. And I think that I'm of two minds about that. The note I made to myself was, I think setting all of the cash flows from your bond funds to just pay out in cash and have a person spend them, that's fine. You don't really benefit that much from reinvested dividends and reinvested cash flows on bond funds as a retiree. And we did a whole episode on that some time ago. It was one of our early episodes. So bear with me if you go back and watch that one, where people like to think, well, in periods of real market volatility, I really like the fact that my dividends are being reinvested. That kind of enhances my return. And it's like, yes and no. On the reinvested dividend portion of your portfolio, certainly, if you buy some stocks at a discount, that will work nicely for you. But in terms of how trivial that is compared to your total portfolio, which experienced all of that oscillation, it's just not going to move the needle that much. So that's why on the stocks or on the bond side, set those portfolio distributions to cash and just use those first and then dip into the corpus after that. No qualms for me on that one. On the stock side, though, if you look at the percentage of your long-term total returns that have come from reinvesting dividends, and this is only true if you're holding those stocks for a very long period of time, I would say you're going to do a little better reinvesting your dividends. And because those are supposed to be long-term holds, a little better over a very long period of time can turn into a lot better. So my approach would be, yeah, if you've got a big portion of your portfolio in bonds, turn the interest onto cash, go ahead and sweep that out, and then just dip into the corpus for whatever it is you need. But on the stock side, let those things reinvest. And then Susan, being a realist here, a pragmatist, says, how do tax considerations fit into this, assuming someone has their portfolio in multiple silos? So this would be a traditional or a tax-deferred account, a Roth, and a taxable account. And the note that I made to myself was, it's a really great point. This is going to need to map to your reality. And so basically, if you have to start considering transaction costs, taxes, all the rest of that, this gets a little bit murkier, but Christine has a decent answer to this. The 3-bucket approach sounds so simple, and it may be for people who have all of their assets in a single account, like a traditional IRA. But the fact is that most of us will be bringing multiple account types into retirement, each with their own rules around taxation and whether distributions are mandatory. You effectively need to overlay whatever sequence you're using for withdrawals from those various accounts over the 3 buckets. Then she says, very generally speaking, tax and financial planners usually consider it best to start retirement spending with withdrawals from taxable accounts or your non-retirement accounts. The reason is that they don't provide tax breaks on an ongoing basis. Not necessarily true, but we'll let her go with this. Your tax on any income or capital gains distributions, absolutely true. Because spending will start with that part of the portfolio, that argues for holding more of all of your liquid assets in the taxable account. Roth accounts, meanwhile, often have the save for later pile. That's because they offer phenomenal tax benefits, tax-free compounding and tax-free withdrawals, and are also terrific assets for heirs to inherit. They're a great place to house assets with the longest expected holding period, the bucket 3 assets, which would mean your middle part of the bucket, which would hold virtually all of your bonds, would be the traditional IRA. That makes a whole lot of sense to me. Now, the Secure 2 Act kind of changed a lot of this from Scott and I's perspective, where the old school mentality of saying, I'm going to have very, very compressed marginal and effective tax rates, in the first part of my retirement, say from retirement day one out until mandatory distribution. That would be for most people age 73 or 75 now. That's a strategy, and it's worked okay. We actually have a client right now who used that strategy, and his effective tax rate in 2024 was like sub 5. So you can make that work really nicely. But there are a couple of things here that Christine said that I take a little bit of issue with. First off, she said you don't get any tax breaks by having assets in your taxable accounts. Not true. The reason that you might want to consider owning equities in a taxable account is for tax loss harvesting purposes, where if you have volatility of an asset, if it goes down in value and you own something like a mutual fund or an ETF, you can very often sell one ETF, book the loss, buy another ETF without having to wait for 31 days. Not an explicit recommendation. Make sure you don't run up against wash sales. But just generally speaking, the IRS regards those as substantially different, which allows you to book a loss and get right back into the market under a slightly different strategy. That benefit only accrues to you in a taxable account. You can't sell assets at a loss or at a gain for that matter in an IRA. Now, you'll have gains for reporting purposes, but you won't have taxable gains in your IRA or your Roth IRA. And the change that was really key in the Secure 2 Act was now that your heirs are going to be inheriting IRAs with a couple of very onerous tax obligations, it makes a little bit more sense, I think, and I think Scott is with me on this, to maybe start dipping into your IRAs a little bit more ahead of schedule. And here's why. Most people have children when they're about 30. So I'm in my 30s. All my kids are very young. By the time I'm at life expectancy, so right now that's hovering right around 80, my kids are very likely to be hitting their peak earnings years. So that would be for a usual person in their 50s. Maybe in some industries it's slightly younger, but most people will hit the peak earnings years in that last decade of work, which tends to be between being, say, 55 and 65. That's fairly standard. So think about how maybe insidious, I don't know, maybe I'm giving Congress a little too much credit here, but think about this from their perspective. They're in their peak earnings years, maybe earning as much money in ordinary income as they've ever earned. Mom and dad pass away. They get a big inheritance and an inherited IRA. Now, they're not going to turn their noses up at that if you've done your parenting properly. So, be encouraged. But you can see that from a tax perspective, it actually might be more onerous for them to be distributing those assets because they're going to have that 10-year rule. And if you live to be 73 or 75, if you've commenced your mandatory distributions, they're also going to have a mandatory distribution. And if they're getting that mandatory distribution in a year where they're already going to have a lot of ordinary income, it's certainly conceivable that you're going to actually lose more of that IRA account to tax than you would have if you had started dipping into it a little ahead of what the traditional financial, publications or financial planners or whatever would have suggested that you do. So I think it definitely is, you're going to need a little bit more of a nuanced income blend in retirement now, keeping that in mind. So I'm totally on board with the other aspects of it though. Virtually, if you're going to own really stodgy fixed income investments, the traditional IRA is the way to do it because that's producing a lot of really inefficient income. And by inefficient, I mean very tax sensitive income because interest is going to be considered ordinary income. And then the Roth IRA, accepting some kind of one-off, very large distribution you might need to make. Mo brought up the topic of that could be how you do your long-term care. That is really going to be where you're going to want to have all of your high-octane, high-growth assets because as Christine lays out here, the only benefit of the Roth really is every dollar you earn in excess of what you paid tax on. Because remember, every dollar that went into a Roth has already been taxed. So the delta between what you put in and what it ultimately is worth is where all of the tax benefits rest. So if you're going to set up a bucket strategy, you do need to keep these sort of tax silos in mind as well. And I think that Christine does a decent job of kind of laying out how that might work. But that really got us to the end. And I know we went through a lot of stuff there. So I'll just give you my parting thoughts on that and say, I feel like Christine did a really good job describing how you could use the bucket approach, not just to manage risk in retirement, which is really where Scott and I tend to approach our investment philosophy, is we're very sensitive to risk. Most retirees have worked a very long career. They've been diligent savers, and they just don't want to see their portfolios lose a tremendous amount of value. We're very sensitive to that. However, the other thing about this is it's very practical. I think a lot of people can wrap their head around this. It's not esoteric. It's not some crazy strategy. It's not intricate. It's we're giving things a job. We are literally looking at parts of our portfolio and saying, I understand why I own this and why I own it in this proportion and why I own it in this part of my account. I understand what this is doing for me and why it's there. And I think that can give us a real sense of confidence. And I don't think it gives us this illusory sense of confidence where we think we know what's going to happen with the stock market in 12 months. I assure you, if I knew, I wouldn't tell you. But it allows you to look at your portfolio and feel like, I get it. I understand it. I feel like I'm on board with this. Cash is going to provide my short-term income needs. Bonds are going to provide my intermediate income needs. We don't know what the stock market's going to do over 10 years, but if the economy in the United States and elsewhere has done what they have done for many, many years to this point, it's very likely, very plausible that we're going to have more money in that part of the portfolio a decade from now than we do today. And then at that point in time, we have a larger asset and we can make a decision about what to do with it. So rebalancing to some fixed income then could make some sense because we're not really making a timing decision then, or just turning the dividends to cash. So I thought that was a wonderful chapter. I think that we're big proponents of a quasi-bucket method ourselves. Stay tuned for How to Retire Part 7.
This book club series is based on the book How to Retire, 20 Lessons for a Happy, Successful, and Wealthy Retirement by Christine Benz, published in 2024. Thank you for listening to another episode of the Personal Finance Project. This show would not exist without the help of our brilliant creative director, Kira Minifield. Kira, thank you for everything you do to keep this show running. On to the disclosures. This broadcast contains the current opinions of the hosts and are subject to change. The broadcast is provided for informational purposes only and should not be considered investment advice or recommendations. Investors should obtain professional advice before making investment decisions. This is not a complete analysis of every material fact regarding any company, industry, or security. The information has been obtained from sources we consider to be reliable but cannot guarantee their accuracy. Robert W. Baird & Co. Incorporated is not a legal or tax services provider, and you are strongly encouraged to seek the advice of the appropriate professional advisors before taking any action. For more information about any companies discussed, please contact Baird. Past performance is not indicative of future results, and diversification does not ensure a profit or protect against loss. All investments carry some level of risk, including loss of principal. An investment cannot be made directly in an index. Investors should consider the investment objectives, risks, charges, and expenses of a fund carefully before investing. This and other information is found in the prospectus and summary prospectus. For a prospectus, please contact your financial professional and read it carefully before investing. Annuities carry unique risks, including market risk, investment risk, and claims-paying abilities of the insurer. There may also be instances where a contract will pay out less than the premiums paid or expire within the lifetime of the insured. There may be penalties for early withdrawal, and they are not insured by the FDIC because they are insurance, not an investment. Investors should consider carefully information contained in the prospectus or, if available, the summary prospectus, including investment objectives, risks, charges, and expenses. You can request a prospectus by reaching out to your financial advisor. Please read the prospectus carefully before investing. Investment returns will fluctuate and are subject to market volatility, so that an investor's shares, when redeemed or sold, may be worth more or less than their original cost. Unlike mutual funds, shares of ETFs are not individually redeemable directly with the ETF. Shares of ETFs are bought and sold at market price, which may be higher or lower than the net asset value, NAV. Baird does not issue or underwrite mortgages and does not service mortgage lending services. Any references to mortgages in the financial services offerings are purely intended to convey an engagement in this holistic planning process, with this as one piece of the larger picture, which may or may not apply to all clients. This broadcast may not be reproduced without express permission of Robert W. Baird & Co. Incorporated.